Bitcoin. At the beginning of the year, I said the breakout asset was going to be Bitcoin. I think it looks like it's going to be the resounding inflation hedge asset for the next 50 or 100 years. So that die has been cast. I think you're seeing the last vestiges of people using gold as a rational economic insurance policy, but I think the future is specifically Bitcoin on that dimension. So I guess you could trade that, you could speculate on that.
At the dawn of Bitcoin ETF approvals, venture capitalist Chamath Palihapitiya made a bold prediction, declaring 2024 as the most significant year for Bitcoin. His foresight is proving remarkably accurate, as we witness unprecedented inflows into Bitcoin ETFs and the cryptocurrency's price once again flirting with all-time highs after a 7-month consolidation period. The recent surge in Bitcoin ETF activity has been nothing short of extraordinary. BlackRock's iShares Bitcoin Trust has emerged as a frontrunner, experiencing a remarkable $3.36 billion in trading volume on Tuesday alone, its highest in 6 months. This was accompanied by a staggering $642.87 million inflow, the largest in over 7 months. These figures contributed significantly to the overall $870 million inflow into US Bitcoin ETFs on the same day, marking the highest since June. This surge in ETF activity is not just a testament to growing institutional interest, but also indicates a potential fear of missing out, FOMO, rally among retail investors. As Bitcoin's price hovers above $72,000, the market is abuzz with anticipation of a new all-time high in the near future. Chamath's optimism extends beyond the current rally. He believes Bitcoin could reach an astonishing $500,000 by October 2025, a prediction that, while ambitious, doesn't seem entirely out of reach given the current market dynamics. The influence of major players like BlackRock, whose CEO Larry Fink highlighted Bybit's growth to a $23 billion market in just 9 months, further fuels this optimism. As we observe this unfolding scenario, it's clear that Bitcoin ETFs are playing a crucial role in driving market momentum. According to Econometrics, ETFs have been the main driver of Bitcoin's uptrend over the past 12 months, creating significant demand pressure. Chamath believes Bitcoin can reach more than $500,000 in October 2025. So, let's listen to one of Chamath's latest interview about crypto and Bitcoin necessarily.
There's another couple of nuances here that I think are important. The US dollar complex is thriving, which means like the US dollar is strong. Back-end yields are rising. And then another thing that I look at is this thing called put-call skew. So basically, like, on balance, how are people hedging in the short term? And in the bond market, they own a lot more puts than they do calls. I think that this is the entire financial infrastructure of the world repositioning itself from what was a toss-up election to a Trump win. And when you look at why, it's because when you forget the candidates themselves for a second, but if you think about the actual policies and where the spending will occur, I think that there has been a very clear decision that the Trump economic plan will drive better growth than the Harris plan. And if you think that there is more growth coming, typically what will come with that is a little bit more inflation. The risk premium that you're going to need in a high growth environment is higher. What is risk premium? That is, how much do I want to invest for a risky asset versus a safe asset? And so all of these things are coalescing. So I think that the short-term takeaway that I have just looking at all of this data is that in the economic distribution of outcomes, this is now tilted overwhelmingly to a Trump win. And this is not an emotional statement or what I want to happen, but this is just an observation of how tens of trillions of dollars of self-interested financial actors have now repositioned their risk. And if Trump wins, which it looks like he's increasingly going to do, and if he wins by the margins that it looks like it's going to do, you're going to see a lot of these things exacerbate. Gold's going to go up more probably. Bitcoin will probably go up. The short-term economic upside for the economy will probably get reflected in higher equity prices. but it'll also push out long-term rates. The inflation picture becomes a little bit murkier. But I think that that's what's happening. I think that the financial markets are pricing in a Trump win.
Sorry, just to understand better, why does gold go up in a Trump win?
I think in the short term, what happens is that you see more economic growth, but in the medium term, inflation goes up, and so you want to hedge.
Right.
So it's more about a durational balance of assets. So in the short term, you'll be long the things that will generate earnings, but in the medium to long term, you want to hedge yourself. So Bitcoin and gold, I think, will trade that way.
As you heard right there, the key line that Paul Tudor Jones said was all roads lead to inflation. I mean, that's what's basically happening right now, is that the market is afraid that inflation is not whipped and is going to resurface, and the Fed may have to pivot from the pivot and raise interest rates. That's why he doesn't want to own any treasuries. Separately, another financial legend, Stan Druckenmiller, gave an interview where he has something like a 20% short position, meaning 20% of his holdings are short US treasuries right now. So he's betting that there are long-term inflation pressures and that rates are going to have to rise. And you're seeing again that since the Fed cut rates on September 18th by 50 basis points, that the 10-year T-bills yield has risen by 60 basis points. So I think my interpretation is that this is less about the election and more about the markets not liking the Fed's rate cut on September 18th. I think that in hindsight, so again, the market is concerned that inflation is not whipped, that the Fed may have been overly precipitous in how it cut rates. And then the other thing is they just do not like the long-term fiscal picture of the US. One other chart we should bring up is interest on the national debt. What you can see here is that it has gone absolutely parabolic in the last couple of years. Our interest on the debt, something like 1.3, 1.4 trillion a year.
1.35 trillion run rate. Yep.
Yeah.
$3,500 per American.
And it's something like 20 to 25% of federal revenue now is going to debt service. And this continues to increase. Now, I think there was an expectation that we'd be able to get this line to go back down once we had rate cuts, right? Because if inflation's licked and the Fed can lower interest rates again, and we can get back to a 2% 10-year bond, which is where we were a few years ago, then all of a sudden that national debt service becomes a little bit more reasonable, right? I mean, you could service that debt at half the cost. But now it looks like that may not happen. So just to wrap this up, I just think that the market doesn't like these fundamentals of the US fiscal picture. You've got rapidly increasing debt service costs. You've got an inflation picture that is murky and may not be going away. And the bond markets are starting to price in higher interest rates for longer. And this is why Paul Tudor Jones is saying all roads lead to inflation. And this is why Druckenmiller is shorting US treasuries.
So just to give you guys a sense, total US household, corporate, and government debt, which includes state and local and federal. So household debt in the US about 18 trillion. Corporate debt's about 11 trillion. State and local government debt's 3 trillion. Obviously, the federal debt, 36 trillion. That adds up to a whopping $68 trillion of total debt across the US, which if you assume a 6% average interest rate, you got corporate debt and household debt, so it's a little more risky, so it carries a higher rate. That means we're spending about $4 trillion a year of an economy that's only 29 trillion a year to service the debt, just to pay the interest on the debt. So 15% of every dollar that trades hands is going towards interest payments on existing leverage, on existing debt. It's a highly leveraged system. And if you look around the world, this problem is not just a US challenge. Global leverage is a problem that's now becoming a crisis for countries everywhere. So this is becoming kind of a global leverage problem, which might explain the flight to safety in assets like gold and Bitcoin, and is going to present a lot of real struggles for every global economy. Now, the question is, does the US dollar maintain its reserve status? Because ultimately, I think it is inevitable that the Federal Reserve in the United States is going to need to buy the debt. They're going to need to monetize the debt, which means printing money. There is no one else to buy the debt. So pull up the China chart, Nick. China's historically been the biggest buyer and owner of US treasuries, but here's what's happened in the last couple of years. It peaked at about $1.3 trillion
And that's all for today from Chamath and the team. We hope you liked the content and their analysis about Bitcoin, crypto, and overall global financial market. If yes, then make sure to like the video and subscribe to our channel if you haven't yet. See you in the next video.